Welcome to the Deep Dive. Given everything happening in the Middle East lately, we're focusing today on this crisis involving Iran, Israel, and that vital waterway, the Strait of Hormuz.
That's right. And our goal here is really to sift through all the noise, using the latest intel and what's happening on the ground to give you, the global investor, the key takeaways, especially, what it means for places like India.
Okay, let's dive in. What exactly triggered this most recent flare-up?
Well, it seems to have really kicked off around June 13th. That's when Israel conducted those precision airstrikes targeting Iranian nuclear and military sites.
And that immediately led to threats from Iran.
It did. Strong retaliatory threats came pretty quickly after that.
And the Strait of Hormuz. That came up because of those strikes. I remember hearing about a specific Operation Midnight Hammer.
Exactly. So the U.S. was involved with Operation Midnight Hammer. They used B-2 stealth bombers and, crucially, MOP bombs. Those are massive ordnance penetrators designed to hit hardened, buried targets.
MOP bombs.
And reports suggest these strikes did significant damage to Iran's capabilities. That seems to be what pushed hardliners in Tehran, even in their parliament, to seriously talk about, maybe even vote on, closing the strait as a form of leverage.
Right. Now, the strait itself, just remind us how critical this narrow passage actually is for global trade.
Oh, it's absolutely fundamental. You've got something like 20 million barrels of oil passing through there every day. That's roughly 20% of global supply.
20%?
Yeah, and about 20% of global LNG, too. It's incredibly narrow, just 21 miles wide at its tightest point. And for major exporters like Saudi Arabia, UAE, Iraq, Kuwait, Qatar, it's their main route to the open sea.
And Iran has made threats before, right? Seizing ships and so on.
Oh, yes. There's a history.
Oh.
Vessel seizures, more recently, 2022 to 24, harassment, going back to the tanker war in the 80s. But critically, they've never actually gone through with a full, sustained closure.
So when these threats emerged after the June strikes, how did the markets react? Was it immediate?
Instantaneous. Oil prices spiked somewhere between 7 and 11%, pretty much right away. It's a stark reminder of just how sensitive markets are to any instability there, a real vulnerability.
Okay, so Iran knows closing it fully is a massive step with huge global consequences. Why even make the threat? What are they trying to achieve politically or strategically?
It's multifaceted. Partly, it's deterrent signaling to Israel and also to the U.S., who they often see as complicit. It's also about pressuring Western nations over their support for Israel.
And maybe shoring up support at home.
Definitely. Rallying domestic factions, especially the hardliners, is part of it. And look, after taking military hits, it's a way to try and regain some diplomatic leverage on the world stage.
But the economic cost to Iran itself, surely that's enormous. They export their own oil through there too, don't they?
Absolutely. That's the crucial calculation. A full closure would inflict severe economic pain on Iran itself. Lost oil revenue, alienating key partners like China, even India. Most analysts agree it would be, frankly, economically disastrous for Tehran.
So the threat is more like a geopolitical chess move, a bargaining chip.
That seems the most likely interpretation, yes. It suggests a full, prolonged closure is, well, probably unlikely because the self-inflicted damage would just be too great.
Okay, let's broaden out to the global picture. You mentioned that 20 million barrels of oil, 20% of LNG. Which specific countries, which companies are most exposed if things do get disrupted?
Well, the Gulf nations are obviously front and center. Saudi Arabia, UAE, Iraq, Kuwait, Qatar. Many don't have significant pipeline alternatives. Then you've got the tanker companies, names like Frontline come to mind, and of course maritime insurers. They're all watching this very, very closely.
And the price impact. If supply was cut off, even temporarily,
you'd see an immediate sharp spike. Brent crude could easily jump into the $90, maybe even up towards $130 per barrel, depending on the severity and duration.
And that's not just petrol prices. Shipping costs would soar too.
Exactly. War risk premiums for insurance would skyrocket. Freight rates would jump. Ships would be forced to reroute, probably around the Cape of Good Hope in Africa. That's much longer, much costlier. It hits global supply chains hard.
Which means inflation.
Yes. Significant inflationary pressure. A rule of thumb is often that a $10 rise in crude can add maybe 0.4 to 0.6% to global inflation. That could easily derail plans by central banks around the world to cut interest rates.
So for investors, the takeaway is brace for potential inflation shocks, supply chain messiness, and just general volatility.
Precisely. Across energy, shipping, anything heavily reliant on imports.
Okay, let's focus specifically on India now. How vulnerable is India to disruption in the Strait of Hormuz?
Hugely vulnerable. India imports, over 85% of its crude oil needs, and a massive chunk of that, maybe 60–70% of the crude and 40% of its LNG, comes from the Gulf region.
And how much of that goes through Hormuz?
The vast majority. Estimates are around 83–84% of India's total energy imports transit through the strait. So any disruption, even short-term, dramatically increases India's import bill. Strategic reserves help buffer, but only for so long.
What does that do to the wider Indian economy? The rupee, for instance.
It puts serious pressure on the rupee. We already saw it weaken recently. A sustained oil price jump, say $10 higher, could easily knock the rupee down further, maybe towards 87, 87.5 against the dollar. It also widens the current account deficit significantly.
And that complicates things for the Reserve Bank of India.
Absolutely. Higher energy costs mean higher inflation, making it much harder for the RBI to cut rates. They might even have to consider hikes. It also strains the government's fiscal position. So for investors looking at India, you need to watch the rupee inflation, and RBI moves very carefully.
So for anyone trying to track this, what are the key signs that Iran might actually be moving towards disrupting the strait beyond just threats?
You look for concrete military signals, things like Iran's Revolutionary Guard Corps Navy, the IRGC, deploying more naval assets or missile systems near the strait, or maybe conducting specific naval exercises there. Electronic jamming warnings are another indicator.
Are we seeing any of that now? How are markets pricing this risk in real time?
Well, Brent crude is already up noticeably, about 18% since mid-June. We are seeing rising war risk insurance spreads, and tanker rates, especially for the big VLCCs, very large crude carriers, have jumped up around $50,000 a day now.
And the big geopolitical players,
Yeah.
U.S., China, Saudi Arabia, what are their stances?
The U.S. is clearly reinforcing its naval presence in the region. China and Saudi Arabia are, let's say, cautious. They don't want conflict, but they're also very wary of the economic impact of sustained high oil prices.
How about specific stock sectors? Energy, shipping.
It's a bit mixed. Energy stocks, especially tanker operators like Frontline, I think they're up nearly 40% year-to-date. They're benefiting from higher rates. Upstream oil and gas producers, too. But airlines, big fuel consumers, and companies in countries that are net energy importers, they're facing headwinds.
Okay, crystal ball time. What's the most likely scenario going forward? Full closure? Or just posturing?
As we discussed, full closure seems highly unlikely because of the self-inflicted economic damage. But the chance of short-term, maybe asymmetric disruptions, harassment, temporary blockades lasting days or weeks, the probability is definitely higher now. It's not just posturing.
And the risk of this escalating? Miscalculation.
That risk is significant. A misstep, an accident, could easily spiral into a wider conflict, potentially drawing in the U.S. or other nations.
Will the international community step in? Naval forces?
Highly likely. Ensuring freedom of navigation in the strait is a global priority. You might see efforts to reactivate or strengthen international naval coalitions, maybe something like the previous International Maritime Security Construct.
Could this crisis spill over? Maybe connect with the Red Sea issues, the Houthi attacks?
It's possible. You could see heightened tensions across multiple maritime choke points, potentially linking the Gulf and Red Sea theaters. It definitely increases overall regional instability.
Here's a thought then. Could this whole crisis, even if it blows over relatively quickly, actually speed up the global shift away from fossil fuels and towards more diversified, maybe localized energy supply chains? Could it reshape energy investment long term?
That's a really interesting question. It certainly highlights the vulnerabilities. For you, the investor, the immediate takeaway is prepare for volatility. Diversify, perhaps consider hedging, keep a very close eye on the geopolitics. But yes, also think about those longer-term trends in energy transition and supply chain resilience. So we've covered the triggers, Iran's motivations, the potential global fallout, particularly for India, and what to watch for. Hopefully understanding these pieces helps make sense of a very complex and fluid situation.
Absolutely. The key takeaway, as always, is stay informed, think critically about the connections, and look for those underlying factors that really drive market moves. Thanks for joining us on The Deep Dive. We'll be back next time.